Nvidia posted a record quarter, then dropped 6% in a day. It didn't miss, the AI trade did. Nvidia is one of the largest companies on Earth, by some market cap feeds, sitting just below $5 trillion. And in its most recent quarter, it did not stumble. It posted record revenue of $81.6 billion, up 85% from a year earlier. Then, on June 5th, the stock fell about 6% in a single day. So here's the puzzle this video is about. This is not the simple story of a bad company with a falling stock. The business put up record numbers, and the market sold it anyway. When a great quarter and a falling price collide, the instinct is to pick a side. The bulls say the drop is wrong. The bears say the quarter is a trap. Both are too quick. The honest read is that the price and the fundamentals are measuring two different things. And to see what each one is actually saying, you have to read this drop through four separate lenses. The quarter was the company. The drop was the market. Start with what actually happened. Because Nvidia didn't report that week. The spark came from a competitor. After the close on June 3rd, Broadcom, the custom chip leader that builds silicon for giants like Meta and Google, gave its next quarter outlook. Its AI chip revenue guide came in around $16 billion, just under the roughly $16.4 billion that analysts expected. And crucially, it did not raise its longer-term AI target. The next day, Broadcom stock fell sharply, and the whole AI chip group fell with it. Then on June 5th, the second blow, a stronger-than-expected jobs report. Payrolls rose 172,000, against expectations near 80,000, with unemployment at 4.3%. Good news for the economy, but the market read it through the bond market, where a hot labor market means interest rates stay higher for longer, and higher rates hit the highest-priced, longest-duration assets hardest. That is the AI complex. So Nvidia walked into a sell-off it didn't start. The news came from Broadcom and the labor market. Lens 1 is the price itself, and read this way, the story is fear. On the day, Nvidia fell about 6%, and from its recent high, it was down into the low teens percent, a correction, not yet the 20% drop that marks a bear market. Underneath, you could see the de-risking directly. Inverse-semiconductor products, the funds that profit when chips fall, were among the most active trades, one of them up more than 30% on the day. That's what a crowd reaching for downside protection looks like. But notice what Lens 1 can and cannot tell you. It tells you the market got more afraid and reached for cover. It does not tell you whether that fear is justified by the business. Price is a measure of mood as much as merit. And on a macro shock day, mood leads. The tape doesn't measure value. Lens 2 reads the same drop through the income statement, and here the picture flips. There is no demand collapse in the reported numbers. Revenue was $81.6 billion, up 85% year over year. The data center business, the engine of the AI buildout, was $75.2 billion, up 92%. Gross margin held near 75%, and the company generated about $48.5 billion of free cash flow in the quarter. Its guidance for the next quarter is roughly $91 billion in revenue. And notably, the company says that outlook assumes no data center compute revenue from China at all. So on trailing earnings, this does not look like a no-revenue bubble. But stay honest about what Lens 2 proves and what it doesn't. It shows no reported weakness in the last quarter. It does not rule out what comes next, and that China line is a reminder that strength and risk can sit in the very same sentence. The income statement says growth, the price says doubt. Lens 3 is the one the bull case skips, so give it real weight. The strongest bear argument is not that nobody wants AI chips. Clearly they do. It is a question about money and structure. Who keeps paying for all of this, and for how long? The build-out runs on enormous capital spending, and the market is starting to ask whether that spending is self-funded out of profits, funded by debt, or financed in a circle, where the same AI ecosystem keeps buying from itself. On top of that sit four more pressures. Customer concentration. A handful of giant buyers drive much of the revenue. Custom silicon. Those same giants, Broadcom's customers, are designing their own chips to depend less on Nvidia, which is exactly why Broadcom's quarter mattered. Export controls. The China line we just saw cuts both ways, and margins this high tend over time to normalize rather than rise forever. There's even competition for the capital itself, with mega listings like SpaceX and the coming AI lab IPOs set to soak up investor dollars. None of these is a verdict. Together, they are the real risk. The question isn't who wants the chips, it's who keeps paying for them. Lens 4 ties the other three together, and it is the climax, because it explains the whole paradox. Look again at what actually broke the tape. Broadcom did not collapse. Its AI revenue was up triple digits. It simply did not beat by enough, and did not raise the long-term number, and the market punished it anyway. That is the tell. After a run this large, a great result is the assumption, not the surprise. The price already contains a great deal of future success. So the reaction to Broadcom suggests the bar across the whole AI trade has quietly become perfection. Apply that to Nvidia. Its risk, on this lens, is not that last quarter was bad. It plainly wasn't. The risk is how much flawless execution is already embedded in the price, and how little room that leaves when a macro shock or a single soft guide arrives. This is where fear and fundamentals finally meet. The fundamentals set how good the business is, and expectations set how good it has to be. Nvidia's quarter wasn't the problem. So, here is the honest scoreboard. What each case depends on, not a prediction and not a recommendation. The bull case needs 3 things to keep holding together. AI capital spending stays strong, margins stay near these levels, and the rate pressure eases rather than builds. The caution case needs only one of several things to break. Rates push higher for longer. The capex cycle slows into digestion. Custom silicon eats into Nvidia's share. Export limits tighten, or one quarter's guidance simply disappoints a bar set for perfection. Those aren't forecasts. They're the markers to watch. Track whether real rates climb or fall. Track whether hyperscaler capex guidance holds. Track Nvidia's own gross margin and its China commentary. And refute the lazy framings directly. The bulls who say great quarter so the fear is wrong, and the bears who say it dropped so the boom is over, are both reading half the board. Fear and fundamentals aren't opposites. They're reading different parts of the same machine. The next prints, capex updates, and rate moves should show which part is winning. One last thing, and it matters. This breakdown was AI-assisted and externally reviewed, and it's built from primary sources. Nvidia's own quarterly results and presentation, Broadcom's report, and Reuters' coverage of it, the Labor Department's jobs release, and live market data for the June 5th close. Every one of those numbers moves. The share price, the market cap, even which side of the 5 trillion line Nvidia sits on depends on the feed you use. So re-verify before relying on anything here. This is descriptive analysis, not financial advice. There is no buy, no sell, no price target, and no timing call anywhere in this video. The goal was only to show why one drop means 4 different things through 4 different lenses. So you can do your own work. Read the filings, check the sources,